Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am Pushpendra Mehta, and my guests for today are Jack Large, editor of CTMfile, and Craig Jeffery, managing partner at Strategic Treasurer. This week, we are focusing on 5 themes that cover 7 stories. US and China's landmark audit deal, Euro reaching a 2-decade low, the US Federal Reserve advocating additional interest rate increases, the UK scaling up emergency exercise to prepare for possible energy shortages, European energy crisis threatening to spiral out of control, and finally, Hong Kong's people exodus. You can read these articles and also research content more deeply by visiting CTMfile.com or by following the links in our show notes. Jack and Craig, let's begin our discussion with the first section that revolves around US and China's landmark audit deal that may be a boon for Chinese tech companies. Last week, Beijing and Washington took a major step towards ending a dispute that threatened to boot Chinese companies, including Alibaba, from US stock exchanges, signing a pact to allow US regulators to vet accounting firms in China and Hong Kong. US regulators had warned that without an agreement, some 200 companies might be ejected from US exchanges or face trading restrictions. Craig, if I may start with you, this agreement will be meaningful only if US regulators actually can inspect and investigate completely audit firms in China. Do you think the words agreed to on paper will translate into complete access in practice?
I'm not sure it'll translate to complete access, but probably pretty close to complete access. It's a global economy. Access to global capital is vital for every country, China in particular, even though they're the second largest economy. This is vital for them. And so access to the free markets and the capital markets requires transparency, and this is crucial. That's the role of audited statements, and a lack of transparency means a lack of trust. Nobody will invest in them, and regulators in different countries like the US will block that if that's not the case. So it should incent everyone to do that. An individual country can decide what their requirements are for that, but when you're trying to access the global markets, visibility, transparency is vital. So yeah, I think we'll get there on these.
I'm afraid I'm not as optimistic as Craig is. I have particular experiences of the reluctance of the Chinese government to give full information about operations within their country. I remain to be convinced. I think we need to be cautious here.
The next story is about Euro reaching a 2-decade low. The resurgent dollar and the likelihood of a challenging winter for the region has caused the euro to drop to a new 2-decade low, according to Bloomberg. Morgan Stanley believes that euro is expected to fall to 97 cents, the lowest level since the early 2000s. Jack, do you think the euro may reach the 95 cents level or even slide further, given Europe's energy woes that may increase the risk of blackouts and potential increases to euro imports?
I think we don't know. It could be. The key issue is that Europe hasn't sorted itself out like the UK government. The strategy on energy wasn't very long-term, and it didn't have any risks built into it, risk coverage that built into it, and we're bearing the problems. I'm pessimistic.
The article talks about a resurgent dollar, and it seems less about a resurgent dollar and more about a declining euro and other areas, risks that other areas face. The issue with winter coming, the energy problem, moving towards recession, which areas are more likely to be stronger in recession, and the interest rate differentials. these are significant concerns. I mean, these are headwinds, cross currents. If things continue as they are, and there's always adjustments, but if they continue as they are, we would expect to see a continued weakening of the euro. That's one aspect of this. Hope it doesn't occur. Hope things strengthen. The energy issue gets fixed. But we see that in more areas. The feedback of this energy shortfall in different areas, and then weakness of economies, and then central banks trying to recover from that. The level of recession's a key concern here.
Moving forward, the next two stories about expected interest rate hikes to combat inflation. Last week, central bankers in the US converged in Jackson Hole, Wyoming for their annual summit. The US Federal Reserve Chair delivered a stark warning Friday about the Fed's determination to fight inflation with more interest rate hikes. Inflation is a dominant threat, with 55% of business leaders in the UK believing they lack the necessary resilience to deal with it, which rises to 65% in the United States, according to the report titled Spotlight on Geopolitical Risks, published by the specialist insurer Beazley. From a Treasury perspective, the UK-based Association of Corporate Treasurers' recent Business of Treasury 2022 report survey corroborates the inflation unprepared notion and states that many treasurers will have never worked in a high inflation environment before, which explains why inflation is now the second highest external concern for treasurers, alongside geopolitical uncertainty. According to an article published in the Wall Street Journal in July of last year, many of the current generation of chief financial officers have limited experience in managing inflation following years of low-cost increases in the US and elsewhere, making them seek past playbook strategies. When you hear about imminent interest rate hikes, inflationary pressures, and the news that many of the current generation treasurers and CFOs have limited experience in managing inflation, what are your reactions?
Just from a perspective, I remember as a kid when inflation was extremely high, I had a source of income delivering papers, cutting lawns, and I went into money market funds, and inflation was massive, and it was having a significant impact on businesses, across the mix. And you're right. I mean, your key points that many haven't lived through that. And so it seems odd and strange. And how do you react to these types of activities coming together? I guess when I think about that is we've gone from a time where there was relative calm in the markets. FX rates didn't seem so volatile. Interest rates were low. Central banks were, providing plenty of liquidity for quite some time. And so now we've reached the end of some of these eras. And so the chop is coming from multiple directions. And so we need to solve for multiple items in our treasury rolls at once. And that's not really been the case for many, many organizations. And so I think that presents a bit of a risk. What heartens me is a lot of treasurers are doing more modeling, more activities. COVID put more of that back on the table. So there's been more attention to that. I really think since 2008, 2009, there has been a permanent shift to more analysis and more looking at things than before, back when there was high inflation. So I'm more on the optimistic side than the pessimistic side by a bit, 55%, just past the middle, largely because of what we've experienced over the last couple of years. But still, these are not insignificant headwinds and overhang of, of the balance sheet, of what's going on with inflation and attempts to combat that.
The basic model for controlling inflation by central banks raising interest rates has, I think, starting to be questioned. In the UK, certainly, we're seeing voices, quite senior and experienced voices, saying it's counterintuitive and we're not sure it's going to work. And my problem is I'm not sure what the alternative is. It's going to be a dodgy few years, and it's going to be years rather than a few months as we sort this out. Inflation doesn't disappear in 1 year. It takes a long time.
Yeah, Jack, one of the things when the Federal Reserve was, quantitative easing, quantitative tightening, when they made the shift between those two, a little over maybe about 2 years ago now, it only took a few months of just dumping, 50 billion back into the market before the economy seriously tightened up, became a problem. They stopped that. The overhang on the balance sheet is significant, let alone inflation. And so I think it's going to be kind of interesting to see how this plays out. But we have less margin for error than we've had in the past.
That is also linked to our next story for today, which is the UK's power transmission network, National Grid, doubling its emergency planning exercise from 2 to 4 days amid fears of a spiraling European energy crisis. Experts will wargame for 4 days in September what will happen if gas supplies are reduced, which could trigger a need to ration electricity. Gas and electricity bills in the UK are expected to hit £5,300 when next April's price cap is announced, piling further misery onto British residents as inflation keeps climbing. Experts at financial firm Citigroup have said the CPI index, or the Consumer Price Index inflation, which indicates the increase in the amount people pay for goods and services, will hit 18.6% in January next year. Last month, CPI inflation struck a new 40-year high of 10.1%. Jack, from a Treasury perspective, what is your biggest concern when you hear about the soaring inflation and the possibility of electricity rationing?
The biggest worry, of course, is for the people with low incomes and who haven't got the buffer to cope with this level of inflation. My other biggest worry is, and it's equal level, is that the strategic planning for energy, for a whole series of different things, is not being taken seriously. It should have been taken seriously 10 years ago. And we're still not having the understanding of the fundamental change and shift we need to make. I'm very concerned.
We've talked on previous Open Treasury podcasts about food stability, some of the things going on with Russia's war on Ukraine. They're limiting how much of the food gets out. That creates a significant issue in countries across the board that may have food shortages. When we think about heat and cold, the ability to condition the air to make it cooler versus the ability to warm houses and places where everyone lives, many, many more people die from freezing and lack of ability to heat. That's a big concern. Maybe not so much in all of England, but in many countries where there's a fuel shortage, that's going to create significant issues. That, and like Jack said, this is, whether it's wargaming or planning for a period of time, we need to be really careful about each country and each region has to make sure we have enough fuel. Fuel and energy is vital for the health and survival. We have to be careful about it. And we don't always plan for these different scenarios.
There is another issue which is emerging here, which is that we are a global economy. We're an integrated series of countries. However, we deny we don't have responsibility elsewhere. And when you get countries like Pakistan being flooded and losing over 100 million people are destitute and have no homes, thousands of people die, the support required from the rest of the world is going to grow and grow. And at the moment, we've got UK, for example, cutting the national contribution for overseas aid. I think it's going to grow. And it's going to affect the balance in which economies work and how the treasurers see them. I'm not sure we really understand the significance of this.
I think those are good points, Jack. There's two things about how we're adapting this, and both of our countries do those. So in the UK, it seems like the energy price is held for 6 months, and then it resets, and so there's a huge jump after 6 months as opposed to each month. I think that slows down the ability of the supply-demand response. On the other side of the pond in the U.S., we've been releasing from our strategic oil reserves, having about 700 million, I'll just say units, and they're releasing like 1 million a day from our strategic reserves to bring the pricing down as opposed to using the demand to spur additional creation. And those those are not long-term solutions. They tend to exacerbate the situation. So I think we all have a lot to learn and fix on these different fronts.
The next story is about energy major Shell's CEO predicting that Europe's energy crisis will extend beyond winter. Europe's business and consumers face the prospect of a severe winter marked by high power bills and electricity rationing as Russia cuts back gas supplies. Europe is at the center of the energy market turmoil. Speaking at the World Economic Forum in Davos in May, Dr. Birol, the executive director of the International Energy Agency, said, "We are in the middle of the first global energy crisis." And in July at a Global Energy Forum in Sydney, Australia, the chief of EIA cautioned, "The world has never witnessed such a major energy crisis in terms of its depth and its complexity." Power prices in Europe continue to smash records, intensifying the region's energy crisis and fanning fears about access to electricity and heating as the weather begins to cool. Jack, my question to you is that do you think this crisis will be contained in the coming months, or will this fallout trigger a deep recession in Europe?
Certainly, I feel we're definitely going to have a recession, and it's not going to be short. How deep it is will depend on various factors. My real concern is that the overall energy balance globally has got to change from oil-based, carbon-based systems to non-carbon-based systems, and we're not taking it seriously enough.
This seems to be more of the same theme and story. I mean, it's coming from the same source as we see from the UK wargaming, the potential shortages, what's happening in Europe, particularly Germany. I think we're seeing much of the world is in recession. Not all the data's in about that. There's so many indicators if that's the case. We'll probably find out more in the fall of what's going on. People will demand responses to, energy and food. Energy, food, and safety are going to be the big drivers. And that's going to impact the economy and the ability to pay for these massive increases because we're short. When you get short on the edges, people will pay whatever for food or whatever to keep from freezing. But not everyone can pay as much as these things are, going up. And so there's a lot of moving parts that have to be addressed at once.
The seventh story for today is about Hong Kong's people exodus. Hong Kong is witnessing continuous exodus of key workers from the financial sector who are moving to rival destinations such as Singapore and Sydney. The former British colony is struggling to revive its role as a global finance and commerce hub in the wake of the COVID-19 pandemic. Travel restrictions have prompted firms to shift staff from Hong Kong to rival Singapore and elsewhere. Further evidence of a brain drain came in a recent survey by the Hong Kong Investment Funds Association, which showed more than a third of fund management companies moved some or all regional and global roles from Hong Kong to other locations. Jack, if I may address this question to you first, do you think these developments will undermine the city's role as an international financial center? Or is this just a temporary blip?
This is a classic example of what happens when you get variation between the different centres. So Hong Kong, like China, had much more strict COVID regulations than, say, Australia and Singapore. But it also shows that the world's workers, the key technology people, the key technicians are quite happy to move centres. It doesn't matter where the centre is, they just move to it. And we're going to see more of this, I think.
I thought this story was interesting because of the shift. I mean, part of it comes from the COVID, part of it, COVID situation, part of it comes from it being a former colony, China not fulfilling its commitments to freedom for the period of time that they're supposed to. And that's going to cause some exodus with people being able to move to areas that are more free and more favorable. And then as the article points out, there's the level of, the lower birth rate that's happening. So it's a challenge for Hong Kong.
Finally, I would like to wrap up this conversation by seeking your opinion on your choice for the biggest or the most important story of the past week and why. Craig, if I may start with you.
I think the biggest story, because it has a human element and an economic input, has to do with energy. There's a lot of facets, as Jack and I have talked about, to this, about this looming issue, the shortfall, the rising rates as we approach winter. This is really significant. This seems to tie all these items together and ties that into what corporate treasurers need to do. There's headwinds and cross currents for sure. This is impacting inflation. It's also driving a reduction of productivity, leading to a recession. Much of it's centering around that. That would be my top stories or theme for this week.
My theme isn't a particular story, but the theme is lack of planning, lack of understanding of the dynamics of the problem. And we're suffering badly from poor leadership in many different places around the world.
That was a very interesting conversation. A big thank you to you, Jack and Craig, and to our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.